Welcome back to Investing Talk Podcast.
Today we're looking at Albemarle.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. If you've been following the commodity markets, you know the lithium sector has just gone through what we could call, well, a brutal winter.
Brutal is the right word.
For the last couple of years, the whole narrative has been just fixed on the downside. The EV slowdown, massive price corrections.
Right. It was a period of fear and companies just trying to adapt to a market bust.
Exactly, retrenchment. But what's so fascinating now is how quickly that backdrop is changing.
It really feels like the entire market consensus just pivoted almost overnight.
It did. From preparing for the worst to actively anticipating a major near boom, we're seeing major financial institutions openly cheering what they're calling a new multi-year upcycle.
So it's no longer about adaptation. It's anticipation.
Pure anticipation. And it's not just fluffy sentiment. It's driven by some really hard supply-side constraints. The pain of the last few years has finally created the conditions for a dramatic recovery.
Which brings us to that big number everyone is talking about, Scotiabank's forecast. I mean, expecting lithium prices to reach $20,000 per ton by 2028.
That's the one.
That is a staggering forecast when you think about where prices have been. But, how reliable is that? What makes $20,000 feasible versus just optimistic?
It all comes down to lead time and capital. When prices crashed, miners just stopped spending on new capacity.
Yeah.
And opening a major new lithium mine or a conversion facility, that takes 5 to 7 years. So the investment drought we just went through means the supply pipeline is, essentially bare right when demand is set to accelerate again.
So $20,000 isn't just a number. It reflects the price needed to force new supply online.
It's the price of a structural deficit.
Okay, so if that's the macro stage, let's look at the star player Albemarle. The real test of a leader isn't the boom, it's how they survive the bust.
Exactly.
We know prices were lower, and that hit their top line. Revenue was down about 7% year over year.
Which, considering the complete collapse in the commodity price, suggests they held up far better than you might expect.
That's a great point.
And that's the key. When a company posts a revenue dip but holds volume steady, it tells you they have operational maturity. For Albemarle, their energy storage unit actually reported higher physical volumes.
Higher volumes?
Yep. Driven by record production from their integrated conversion facilities, they kept the product moving, which mitigated the worst of the price decline.
That's impressive execution. But wait, let me challenge that for a second. Volumes were higher, but revenue was down. Isn't that just selling more at fire sale prices? Is that success or desperation?
That's a fair question, and if they were selling at a loss just to move product, you'd be right, it would be desperation. But their strength is in their cost base. By moving higher volumes, they get economies of scale. But more importantly, they leaned hard into cost management. They aggressively persisted productivity improvements and delivered $450 million in savings in 2025.
Wow. They didn't just meet their goal, they blew right past their initial target of, $300 to $400 million?
They did. It shows deep operational discipline. They didn't just weather the storm, they actively lowered their cost structure.
Which means when the market recovers and prices jump back toward that $20,000 forecast?
Those lower operating costs translate directly into dramatic margin expansion. They use the winter to get fit for the spring.
I love that framing. So let's talk about the results of that fitness. Where's the profitability inflection point that tells us this thesis is real?
The forward guidance paints an incredibly compelling picture. I mean, it is a massive swing. If you look at their recent performance, they were posting a substantial diluted loss per share.
And now?
Now, the projection for the end of 2026 is a sharp return to a $1 profit per diluted share.
That's not just a turnaround. That's a huge psychological shift.
It is. And the top line is stable, too. The 2026 revenue guidance is expected to be around $5.3 billion. That's a solid 6% increase over current projections.
So that volume stability is now translating into revenue growth as prices start to crawl back up.
Absolutely. And the analyst community is echoing that confidence. We've seen significant upward revisions in earnings per share estimates, with forecasts pointing toward, 48% year-over-year growth for 2025.
Okay, so to fund this anticipated boom, they need a rock-solid foundation. How ready is their balance sheet?
They are exceedingly well capitalized. They maintained a remarkably stable balance sheet through the whole downturn.
Hmm.
Right now, they hold about $3.5 billion in total liquidity, which includes a very large war chest of $1.9 billion in cash.
That's a huge cushion.
It is. And if you look at their ratios, their debt to equity is healthy at 0.47, and their current ratio is really strong at 2.3.
So for every dollar of short-term obligation they have, they hold over $2 in liquid assets.
Which gives them serious breathing room. They can fund new projects without having to rely on expensive external financing.
All right, let's talk about their competitive position. When you're the leader in a commodity, your moat is built on scale and technology. What makes Albemarle so unassailable here?
It's definitely twofold. First, the scale. They are the undisputed global leader. That lets them negotiate better terms and absorb shocks that would just crush smaller companies.
And their assets are diversified.
Globally diversified. They aren't reliant on one political climate. They're in Chile with Salar de Atacama and La Negra, plus key operations in Australia, the U.S., and their fast-ramping facility in China, Meishan.
And I heard that Meishan facility is actually ramping up ahead of schedule.
It is a clear sign of operational excellence. Now, turning to technology, that's where they really shine. They're heavily focused on proprietary direct lithium extraction, or DLE.
Really? How exactly does that give them an edge in the next cycle?
It's critical because it significantly reduces water usage. This makes their process more sustainable, which addresses a lot of ESG concerns, especially in places like Chile.
And it helps the bottom line.
Crucially, it supports the low-cost production and lets them apply new tech to mature, high-value assets like Salar de Atacama, effectively giving them a second, highly efficient life.
Squeezing out more production for less cost and less environmental impact.
Yeah.
Okay, but to fund that, they need serious cash. What does their cash flow look like?
It's incredibly strong. For the first 9 months of the year, they generated $894 million in operating cash flow.
That's up, what, almost 30% year over year?
A very robust 29% increase, yeah. And they're projected to deliver $300 to $400 million in positive free cash flow for 2025. They are essentially self-funding their own growth.
Plus, they're setting themselves up for a major capital injection in the first half of 2026, right? They're selling off some non-core assets.
Exactly. Those pending asset sales should yield about $660 million in pre-tax cash. And that cash is earmarked specifically for growth, for scaling their operations to meet that 2028 supply gap.
Smart capital allocation. Selling less strategic assets to double down on your core strengths just before the boom.
That's the play.
Okay, so we've established the fundamentals. Let's look at the market. The stock price seems to be reflecting this turnaround already.
The momentum is undeniable. We've seen a clear breakout toward new 52-week highs, hitting that $150 range.
And the outperformance is it's huge. Gains in the 57% to 64% range year to date.
Yeah, that significantly dwarfs the S&P 500, which has only gained about 16%. That kind of aggressive outperformance signals institutional rotation. Big money is moving in.
And it wasn't a gentle ride-up either. I remember a recent single-day surge of over 11%.
That volatility tells you money is flowing in quickly, and it's often driven by institutional enthusiasm. We've seen major firms validate this. UBS maintained a buy and raise their price targets. Scotiabank, of course, upgraded them.
And you have RBC, Citi, all with strong price targets in that $150 to $160 range.
The institutional consensus is definitely shifting toward the boom scenario.
Traditionally, this whole thesis hinged on the EV market, which has had its own speed bumps.
Yeah.
But here's where it gets really interesting for me. There's a powerful new demand catalyst emerging.
This is the wild card that makes the whole thesis so much more robust. We are talking about explosive growth in AI and the need for massive global data center infrastructure.
And data centers need backup battery storage, a lot of it.
An enormous amount. These massive stationary storage systems rely heavily on lithium. So we're talking about a significant diversification of demand beyond just passenger cars.
How big is this AI-driven surge expected to be?
The forecast suggests lithium demand from AI and data centers alone could lead to 2.5 times growth in that sector.
That is huge.
It is, because it protects the long-term thesis. If EV adoption hits a slow patch, you now have this relentless build-out of global computing power acting as a powerful new demand floor for lithium. It just transforms the risk profile.
That makes the whole narrative so much stronger. So just briefly, what are the next critical dates on the calendar you're watching?
First, the Q4 2025 results in early February 2026. That's the first quarter where we'll look for concrete evidence of that profitability inflection. Second, the closure of those asset sales in the first half of 2026.
Which provides the cash infusion.
And globally, of course, the macro tailwind of potential interest rate cuts, which should supercharge electrification investments.
All right, before we wrap up, we have to look critically at the bear case. When a stock has seen such aggressive gains, risks can get overlooked. What are the two primary risks here?
Okay, the first risk is one of timing. There's always the possibility of lithium oversupply delaying the upcycle. If new unexpected capacity comes online faster than we think, it could push that $20,000 price peak out further.
A delay. That's a reasonable concern. And the second risk has to be valuation, especially after a 60% surge.
Exactly. If you look at the forward price to earnings ratio right now, it looks incredibly high, around 286 times.
Which is a number that would spook most investors.
It would. But this is the classic trap of looking at a cyclical stock at the bottom of its cycle. That PE is based on the depressed cycle low earnings of the past year.
So as those earnings rapidly normalize, with that $1 profit per share forecast, that ratio is going to correct itself dramatically.
It's a snapshot of the bust, not the anticipated boom.
And I think the company's internal controls are a solid buffer. That $3.5 billion in liquidity, the proactive $450 million in cost savings, that gives them a ton of flexibility to weather any short-term delays.
I agree completely. The final synthesis for you, the listener, is that Albemarle is essentially the best vehicle to play the inevitable structural shortage in lithium.
It's leveraging its scale, its DLE technology moat, and that impeccable balance sheet.
They're just perfectly positioned for asymmetric upside. They endured the winter and are now ready for a boom driven by the dual engines of EV stability and the surging new demand from AI.
So the story here isn't about trading today's price volatility.
No, it's about recognizing the fundamental medium-term supply shortage. This is an investment thesis that requires patience. A multi-year horizon, positioning capital now for that upcycle projected to peak around 2028.
A great summary.
Remember to subscribe to Investing Talk podcast for more analysis like this.